right? You as a founder have so many things to do, right? You have to fundraise, you need to pitch to customers, you need to build like a world-class team. This is like one less thing that you need to worry about.
Welcome to NY Seed Round, the podcast for curious startup founders.
When investors are pouring money into you, they're trusting you to do the right thing.
In each episode, I dive deep into the learnings and mistakes made by the world-class investors and operators who have helped make the New York City tech ecosystem what it is today. Let's say that you had a blank sheet of paper in front of you and you were coaching a startup founder on how to hire their first VP of finance. What questions would you suggest that they ask? This week's episode is a special edition. When you're at your earliest stages as a company, you don't necessarily have a full-time CFO. And for that reason, many leverage fractional CFOs or accounting firms. So I thought I would speak with one this week. Meet Akshay Shrimanker. He's the founder and CEO of Shay CPA, a certified public accounting firm that specializes in helping startups and entrepreneurs with tax compliance and accounting. This is a really tactical and actionable conversation for founders listening. We cover everything from Section 174 and how it may impact founders moving forward, and we cover common questions that he gets from founders around finances, accounting, and bookkeeping. Shay, thanks for joining me. Appreciate it.
Yeah, thanks, Justin, for having me. Appreciate it.
So first, let me start with so you're a fractional CFO for startups. Tell us a little bit more about Shay CPA and the services that you provide them.
Yeah, so fractional CFO services is one of the services we provide. We're a traditional CPA firm that specializes in helping early stage tech companies with their bookkeeping, financial reporting, tax compliance, and fractional CFO services.
That makes sense. Here in New York, we meet a ton of startups that are earlier stages. A lot of them first-time founders, and especially when it comes to the finances. If they don't have a finance background, they ask a lot of common questions. So I know we were chatting about this before the podcast, but I thought it would be fun to play the role of a startup founder who has no idea what they're doing when it comes to their finances and would approach you and kind of go through some of the common questions that you get. So I want to start with something that's pretty timely right now, actually, for founders that are reliant on R&D tax credits. Can you tell us what Section 174 is and why it matters to startups?
Yeah, great question. So first of all, Section 174 is part of the Internal Revenue Code. And essentially, it's the area that covers and governs how research and development costs get deducted either on your tax return. And it's in the past, it would be done in two ways. One way is each time you have R&D costs, you can take 100% tax deduction on your tax return, or you could have chose to capitalize those costs and then spread them out over time. What happened in 2022 was there was a change in the way Section 174 costs could be deducted. And essentially now the rule is they need to be capitalized and spread out over 5 years for domestic costs and over 15 years for foreign R&D. So it's a massive change for especially early stage tech companies because they do have significant amount of R&D that they are pursuing.
What are the typical sort of costs that are associated with that?
Yeah, great question. So I would kind of put them into like two buckets. So the first bucket I would say is direct costs. So direct costs would be things like salaries and wages, third-party contractors that you've hired, cloud computing costs. And then indirect costs would be things like rent, things like general administrative costs, think patent expenses, legal expenses. So those are really the two buckets, and Section 174 encompasses all of those. So anything, all those costs, if any of them are somehow touching the R&D either directly or in an indirect way, they need to be captured as a Section 174 cost. So I'll give you an example just to demonstrate. And this is an extreme example. So let's just say a company has $1 million of revenue and there is $1 million of expenses. So ordinarily you say, okay, 1 million top line, 1 million revenue. So we have a break even. But in this new regime under Section 174, if that whole 1 million that you spent was on R&D costs, now instead of being able to take that as a tax deduction in the year that it was incurred, you have to spread it out. So let's just say it was domestic expenses, that million would need to be spread out over a 5-year period. And in fact, for the first year, it needs to actually be started at the midpoint of the year. So the denominator becomes 10 So now instead of being able to take a $1 million deduction, you're actually taking $100,000 deduction.
Right.
So now, so in this extreme example, you have $1 million of top line revenue, $100,000 expense, and now you're showing $900,000 of taxable income. And you were coming from a break-even position. So that's the area that I think startups are like starting to wake up to realize that, hey, we may have this problem. And some companies that we're helping, that was an extreme example, but some companies that we're working with, they do have some portion of R&D costs, and if they had revenue in the year, they potentially could have taxable income and now owe income taxes at the federal level.
But I'm a founder and I'm hiring engineering talent. That's the particular piece that's like sticky for people, right? That piece of it is the payroll costs associated with engineering talent, which could be tied to R&D.
Exactly. Yeah. So,
because I think about that when you're pitching investors, like that's the biggest expense.
That's the biggest expense. Exactly. Yeah. So your human capital is definitely the biggest expense. And outside of that, it will be things like just your cloud computing costs. So now with companies that are investing into AI, if you're spending a bunch on either servers or, OpenAI credits and things like that, that will be part of the calculation.
That makes sense.
Yeah.
What's the range of emotions or reactions you've received from founders when they learn about this?
Yeah, so I think like the first is shock and just surprise, because I think founders wouldn't have the feeling that the way these rules are written are to sort of disincentivize them to do R&D. So just to kind of take a step back and explain how this even occurred, back in 2017, when we had the Tax Cuts and Jobs Act go into effect, they had in effect put this rule in to balance the budget back then. And they just thought that a future Congress would fix the problem in 2022 when the rule was to actually go into effect. So essentially, when 2022 came, Congress had taken no action, and there is bipartisan support to change the rule. But as of now, it hasn't changed. And now we're in an election year, and it's kind of become a politicized issue. So founders have been just befuddled as to what to do, and have been trying their best to sort of be a little bit more on top of their financials to sort of carve out what is R&D and what isn't, so that they maximize their tax savings.
So a safe prediction is we probably won't see this resolved until at least like 2025.
Yeah. So just in fact, yesterday, the Senate officially killed the bill. So in January, the bill went through the House. It passed. We thought before tax filing deadlines in April that it may have been resolved.
So that's a major update.
Yeah. So the Senate essentially has killed the bill, and it's kind of been pitted against the child tax credit. So it's the Republicans want this business-friendly incentive, and the Democrats want the child tax credit, and they've been pitted against each other. And now that we're in an election year, it's probably gonna go into next year. So next year, a big update is that the Tax Cuts and Jobs Act, many of the provisions in the act are expiring at the end of next year.
Yeah.
So I'm hopeful that this will be rolled into that whole change, but that just means more pain for founders that are impacted.
Makes sense. What's the difference between Section 174 and the R&D tax credit?
Yeah, that's a great question. So the R&D tax credit, and just to give you a little bit of background on what the R&D tax credit is. So the R&D tax credit is a tax credit that can help offset either income taxes or payroll taxes that a company has. So startups have historically not found the R&D credit useful until very recently. So the last 7 or 8 years, thanks to the passage of the Jobs Act, startups now can deduct their R&D tax credits against their Social Security taxes that the employer pays. So if you're an employer, you typically pay 6.2% Social Security tax, and you match what the employee pays. So the employee pays 6.2%, employer matches it, pays 6.2%. That percentage that the employer has to pay, the R&D tax credit can offset that.
Got it.
So it became a massive incentive for early stage tech companies that are hiring talent, especially in the US, to use the credit to reduce their burn rate, extend their runway. And yeah, now let me just sort of discuss how.
So could like the R&D tax credit like hurt my business potentially, my made up business, hurt it potentially under these new rules?
Yeah, that's a great question. So it's a bit of a misnomer that just because I say, hey, you know what, this year now because the tax rules have changed, I'm gonna not take the R&D credit anymore because it's gonna hurt me. But the Section 174 costs are a lot broader. So the R&D tax credit covers domestic salaries and wages, domestic third-party contractors, and cloud computing costs, versus the Section 174 includes all of that plus foreign salaries, foreign contractors, rent, G&A, everything. So it's a lot broader. And so founders just have to be a little bit careful as to how they navigate it.
Can I ask, how common is it for startups that work with you to have a finance person on staff versus not having any?
Yeah, so I think it kind of depends on the stage of funding that they're at. So if they are a super early stage at,
So you can start at like pre-seed all the way up to IPO. Give us sort of your breakdown of what you see.
yeah, so from pre-seed, we typically see no finance member of the team unless one of the co-founders has some type of a finance background. And then once they get to seed stage, they potentially may be thinking about bringing in outsourced firms such as ourselves or a fractional CFO. And we typically see that all the way through Series A. Series A is really the point where we've seen companies start to think about hiring an in-house VP of finance or a CFO. And at that point, that individual then starts sort of building out that internal finance team, and outsourced providers like ourselves kind of become the back office to that individual. And it's interesting because in some cases, the VP of finance will think that they'll have a lot of latitude to build out a finance team, but it may take a lot longer than they initially thought. So in some cases, we've seen the VP of finance being like a one-person finance department,
Almost like a controller.
Yeah, for like an extended period of time.
Yeah.
And versus, and in other cases, we've seen just them being able to delegate a lot of the responsibilities and build out like a fully formed out like accounting and finance department.
So I'm really curious how you have observed startups build their finance teams or recruit their first finance hires. What have you noticed about the startups that bring on that first finance hire that you still remain working with them? What separates good from great when it comes to hiring your first finance person full time?
Yeah, that's a great question. I think someone who is attuned with the business's current problems is like going to be a big separation. So that we've seen CFOs or VP of finance come in and really transform how a business is operating and sort of get into all the nitty gritty of how it's running, and also understand which players they need on their team to attack which problems. So they're not necessarily coming in and saying, I'm just going to take over all the accounting. I'm going to take over all the taxes. Like, they understand how to sort of delegate what they need to and also attack the pain points that a company has. So I think that's what really separates a good finance hire from someone that's coming in and kind of being more of a glorified accountant.
Yeah.
That's not what you want. You want someone that's really going to come in and be strategic about the way they think about the whole finance function, and really being a partner to the C-suite to add value in areas where like the company may be seeking assistance. Because usually that first VP of finance potentially could be the first, how can I say, the first adult in the room sometimes.
Yeah.
In many cases, who's going to be liaising with the board, is going to be sort of now working with investors, taking the company through due diligence, talking to potential buyers, or working on M&A transactions. So you need someone that can sort of have that broader strategic view versus we have had some instances where someone comes in and the first thing they want to do is like, hey, I just want to pay all the bills or take over the entire QuickBooks. And what they lose there is they really need to be
Well, one at a time, but
yeah, they need to be like 30,000 feet up in the air, and instead they may be getting too much into the minutia. So
yeah.
you just need that balance. Yeah.
Let's say that he had a blank sheet of paper in front of you and you were coaching a startup founder on how to hire their first like VP of finance. What questions would you suggest that they ask to find the right candidate?
Yeah, I think it kind of comes down to experience. So I think a big thing will be, whether they have done something like that before, like have they worked with another early stage company. We have seen some cases where people have been picked out of larger companies, and it can sometimes be an adjustment for someone that may be coming from a larger entity that has a fully formed out finance and accounting department that they are working within, and now they're just a finance department of one.
What I want to double click there. Like, what is an experience that may be new to that type of person that, you as the startup founder need to make sure can they evaluate that? That's not to say like, if you're a startup founder, like don't recruit somebody who worked for a Fortune 500 company. Like, it's not to say that that person can adjust well, but what should that person expect versus where they've been working previously?
Yeah. So I think like, the first thing is they're going to be dealing with sort of founder dynamics, just the way that the team is currently operating. They may have not necessarily dealt with a board of directors before, or like conducted board meetings or been at that level. So when you come in at a startup, as a VP of finance, you're probably going to be looked at to sort of own the finance function overall and have some overlap into the operations area. So one of the questions or the reason, so we've had some Series A startups that we work with that don't hire a VP of finance or a CFO. And usually the question that they ask is, hey, I don't think we have enough for them to do. Right. So what we've generally found is when VP of finances or CFOs are hired, they usually have to do a lot more than just the finance function. It goes into ops, gets into business development. They may be like moonlighting as like the chief revenue officer.
Yeah.
So it's that sort of that dynamic of being able to switch between roles and kind of help the company with whatever it needs at that point in time is, I think, what's like separates a great CFO from being able to, kind of execute.
That makes sense. Also, in my research, I saw that in addition to your fractional CFO services that you provide, you also help with consulting on what the optimal finance stack looks like in 2024 versus like 10 years ago and what's honestly been available today. Where do you sort of see the future of that going? What do you generally like recommend to folks who are clients or prospects? Before we hear their answer, I just want to take a moment to thank everybody for being a part of the NYC round journey since we got started earlier this year. For more founder and investor driven content, like and subscribe. Now back to the interview.
Yeah, it's a great question. So, so typically, at the super early stage, pre-seed, we generally want to see founders, at least at the bare minimum, have an accounting system. So whether that's QuickBooks or whether that's Xero, something that they are actually using that syncs all their data from their bank accounts, any credit cards they're using, services like Row. So we want that to be there, like as the base, and then as they start scaling through different fundraising stages, they will be needing different tech tools,
especially as their finance team grows, right? And you're overseeing a pretty complex close at some points.
Yeah. I think like that's really the key. So like when we're working with teams, like the big thing that we're trying to incorporate is a sense of what is on that month-end close checklist at each stage. So at the super early stage, it may be a shorter list because now you're just maybe reconciling a few bank accounts, reconciling some credit cards, and closing the books. But as the stage of funding grows, or as the complexity grows, you're going to have a lot more inputs into that month-end close process, and investors or other information rights that you have to adhere to. So that's like what we typically help founders and finance teams start to think through as they think about what are the tech tools or what needs to be in the tech stack to achieve that. So I think founders at this point, they have great access to tools that sync really well with their accounting system, whether that's payroll systems, bill pay, spend management systems, treasury management systems. So at this point, it's just a matter of picking the right tool for the right time, and not using too many tools that it kind of just overcomplicates your finance process. We did have last year, I guess, a crisis of confidence in our financial system, and there was sort of a tendency for a lot of companies to now spread their money through various banks and sort of protect themselves. And I think that is a prudent treasury management tool, but you got to balance that with being able to operate at a success as well. Yeah.
That makes sense. It's really not a topic that founders often focus on until it's a problem, accounting in general in your finance function. But what are some of the mistakes that you often see people make? Because obviously, like, fractional CFO services are growing as the startup ecosystem is growing because a lot of these founders don't have this experience. Where do you see them slip up most often?
Yeah, so I think like at the super early stages, it's usually with misclassifying employees as contractors, and then it's sort of more basic things like forgetting to file the 83B elections, or not paying for the stock in their companies.
So paint me a picture. Why are those massive mistakes for founders, each of those?
Yeah, so I think like at the super early stage, when you're like, if you hire people and you're like, let's say you have some level of funding, or if you have revenue and you're misclassifying employees, it's really a time suck, first of all, in having to now either hire an accountant or work with the state authorities or the federal government to clear any sort of back taxes or back pay or insurance. So for instance, in New York State, there's a law for workers' compensation that if you don't have workers' compensation for a 10-day period, there's a $2,000 penalty. So we've just seen small things like that founders have made mistakes on, and it costs time and money to like fix them. Yeah, I think in regards to the resources in the startup, right? So if you are a small team, you're now going to be stretched thin solving these problems, when like your main priority should be working with your customers, improving your product, and sort of building your team. And you don't want to be stuck with these like early teething problems that, like, if you use the right tools and if you get started or work with the right people in the beginning, the right accountants, you can kind of solve these problems.
Got it. Catch me up on your view of the current state of generative AI and its application in finance. Is it there? Which areas of finance are you most excited about?
Yeah, well, first of all, I think like it's doing a great job with like meeting transcripts, even like when you're having conversations with your clients or having conversations with others, just being able to go back through those conversations or review certain notes and things that you're actually discussing during meetings, because it's a great way to jog the memory on certain numbers or certain financials that the client is communicating to you. So I think in that way, it's doing a great job. It's also, as far as like just as a research tool, it has done. There has been some good applications there. There is still a lot of hallucinations that we're seeing in these systems, so they're not 100% reliant. But I think like as a first step, we're seeing some good applications. From the finance side, we are starting to see some GL tools start to roll out ways to like document audit processes or document your month-end close or your workflows. So those are like areas that typically have been in narrative form in the past, where someone actually has to sit and write everything down. And now we're seeing that with generative AI, there is some capacity to at least do a first draft there, and then for a trained professional or CPA or fractional CFO to come in and sort of correct it or make the necessary adjustments to finalize those documents.
Is there an area of generative AI that you're skeptical about when it comes to applications from finance, or just the state that it's currently at?
I guess just the cybersecurity concern, I think, is like the biggest one. Is when our clients are, it's interesting. So when we're working with our early stage tech clients, they're a lot more open to using new tools, new
They tend to be early
technologies.
adopters.
Yeah, exactly. So what happens is if let's say they're using QuickBooks or some type of accounting system, they're connecting these tools to third-party tools, which now are connected to the Gen AI ecosystem.
Right.
So just that sort of level of risk in that, you're sort of opening up your financials or certain proprietary information to these large language models is just a bit of a concern. But I think if those concerns are sort of mitigated, then that should be it should be helpful for startups to sort of have a way to govern. I think it kind of just comes down to governance, right? Like how are they seeing um, when the systems that are connected to these Gen AI systems to make sure that they are um, sending the right information and not maybe disclosing every piece of confidential information in there. Because as accountants, we get access to quite a bit of confidential information, whether that's like people's names, addresses, social security numbers, family members that may be on their health plan and things like that. So you want to be a little bit careful what you open up to the Gen AI.
That makes sense. I want to switch gears to the topic of tax, which I'm sure you guys get a lot of questions about, and just the disclaimers. We're not tax professionals, and make sure to speak to a tax professional. But like a couple questions that probably a first-time founder's asking themselves is, when I start my business, for example, I hear a lot about whether you should start as an LLC or a C Corp, S Corp. What are the general guidelines that you've seen folks ascribe to when it comes to selecting the right choice for you?
Yeah, so I think like you kind of have to start with the end in mind when it comes to thinking about the type of entity type, whether it's a LLC or a C Corp. Um, when you think about early stage tech companies that are venture backed, the majority of them sort of go through the Delaware C Corp journey, but some of them do start out as LLCs. And I think a big part of your determination here is how the company is ultimately going to be financed, whether it's something that you plan to bootstrap, run by yourself, or is this something that it's going to need external financing? Like
So generally you see like the dividing line of like bootstrapping, more LLC is more common. And then if you're looking for VC funding and hoping one day to IPO, that's where you get into C Corp.
Yeah. I mean, we also see that like even LLCs sometimes can enter into safe agreements, for instance, and get and attract investment that way. And then when the LLC eventually does a conversion into a C Corp, that safe investment that you took on now becomes like preferred stock. So there are opportunities to start out as the LLC. One of the main benefits of starting out as an LLC is because it's a pass-through entity. You can essentially have some losses that may be able to offset your personal income. But then again, like, based upon what we spoke about earlier with the Section 174 considerations, you need to take everything into account, and to see whether which vehicle really is going to be the right one for you.
You mentioned 83B elections earlier. For a first-time founder who has no idea what that is, tell them more.
Yeah, so the 83B election is typically it's a document that gets filed with the IRS, and it's a time-sensitive document. It's typically filed within a 30-day period, and in essence, what it does is it prevents taxes from unrealized gains from having to be paid by the founder. So just to give you like an example here, let's just say on day one when the company's kind of worth zero and not much. A founder enters into a restricted stock agreement with to purchase shares in their company. At that point, if it's a restricted stock agreement, they typically will have an 83B election prepared, and they'll file that with the IRS. And then at the end of each year, as their shares vest, they don't have to pay taxes each time their shares vest. But the key here is that with the 83B is that as you raise new rounds of funding, the intrinsic value of your shares is going up. By filing that 83B election, you prevent having to pay taxes on those sort of the value of your shares going up, right? So like you hear things like, hey, like our company's now at a $2 million valuation or a $3 million valuation. The company, the founder's stock is now worth that much as well. So they don't want to be paying taxes on gains that haven't yet occurred. They haven't sold their company yet. So it's all sort of like paper value. So that's why.
And there's a short time window that you can declare it, right?
Yeah. So from the
So sometimes people miss it.
Exactly. So from the time that you sign your founder agreement and your restricted stock purchase agreement, you have a 30-day window to file that with the IRS. And it's a bit of an archaic process because you actually have to physically print out the form, sign it, go to the post office, put it in an envelope, mail it, and get it and sometimes like you may not even get any correspondence back from the IRS. And your only proof that this was ever sent will be like if you have like a certified mail receipt, that you sent it to begin with. Yeah.
What is the qualifying small business stock, and why should founders care about it?
Yeah. So QSBS, or qualifying small business stock, is an awesome tax benefit that founders can take advantage of. Essentially, if you meet all the requirements, you can not have to pay capital gains tax on up to $10 million of capital gains. And at the federal level, at the state level, there are some nuances. Some states honor the QSBS. Other states, like California, for instance, they don't. And you would still have to pay state income taxes. But from the federal level, it's like such a great benefit. And there are some opportunities to do QSBS stacking, which is in effect a way to either through gifts to friends or I guess relatives and or to non-grantor trusts to sort of increase that benefit. So kind of go beyond the 10 million. That's a lot more technical. So you have to speak to, just a disclaimer there, you'd have to speak to your like a trusted estate attorney and tax accountant to sort of set that up. But there are ways to sort of increase that benefit as well. And I think it's a great way for you to have generational wealth. Imagine you have a great exit, the first $10 million, you don't have to pay capital gains taxes on. So there are some requirements. So first requirement is that it has to be original issued stock, meaning you kind of bought that stock off like a fellow shareholder or another founder. Second thing is there's a 5-year holding period. So, kind of back to that question that you had about LLCs. If you have an LLC and then 3 years down the line, you convert into your C Corp, to qualify for QSBS, you have to hold on to that C Corp stock for another 5 years. So that's another reason why you may want to be a C Corp from the beginning. And then the other thing is that not every industry is qualifies for QSBS. So like law firms, accounting firms, we don't qualify for QSBS. It's really more so for more companies that are more innovative in nature. So and software companies, biotech, medtech, those types of companies do qualify in general, depending on what they're doing.
That makes sense. My last question for you is, what's your general pitch for founders who are in the earliest stages, why they should work with a fractional CFO or accounting firm?
Yeah, I think when we speak to founders, I think a big piece here is you as a founder have a fiduciary duty to your company to make sure that you are keeping the books of records. When investors are pouring money into you, they are, they're trusting you to do the right thing by that money. And by hiring an accountant or an outsourced firm like ours, you're sort of making sure you're taking a step in the right direction. So because you're essentially hiring someone that's going to help you with internal controls, make sure that you're overseeing the money the right way, and essentially be able to make sure that you be able to pay your employees, your vendors, sending out invoices to your customers in the right way. So it's just a great way to just stay organized. And again, it's a time saving, right? You as a founder have so many things to do, right? You have to fundraise, you need to pitch to customers, you need to build like a world-class team. This is like one less thing that you need to worry about. And there are some great CPAs and accounting firms and fractional CFO firms out there like ours, so who can sort of step in and sort of help you at those earliest stages.
Awesome. Well, Shay, thanks for joining me. I learned a ton.
Thank you. Yeah, thank you for having me, Justin.